wanted to step in, kind of talk to clients a little bit about what's going on with markets and the Ukraine-Russia situation obviously has everyone rattled, both on a personal and human level, and then all, on a secondary level on the portfolio and looking at your finances and what that means. So we're going to focus on the latter here. But Gary, before I jump into a couple charts to talk about what's happened, any opening thoughts?
Well, I'll talk about this more in a few minutes, but we're in a new world, economically and financially. And, we're going to talk a fair amount about that here because it's changing big time.
Absolutely. I agree. So let's jump in to our charts. So let's talk about first what's happened so far this year. So this is our year-to-date chart looking at the markets. What we have here is basically all the different kind of general areas that people are invested in. We don't own most of these funds specifically, but it's a good proxy for kind of what's happening in the market. So the best performer so far this year is in the green is gold, actually up 6.4% year to date. And then everything else is down. So bonds are down 5.44% so far this year, all the way down to the worst performer is the NASDAQ, down almost 15% or 14.5%. Anything jump out to you, Gary, when you see this?
Well, this is one of the big reasons why we own gold. It's all a part of diversifying, and a part of diversifying is investing in some things that aren't going nuts on the upside when the market is going up, but we're trying to reduce losses in the portfolio, and gold tends to do very well when markets don't do so well, and reducing volatility and helping to minimize losses. Remember, if you have a 25% loss with your portfolio, you have to gain not 25% to get back to zero. You have to gain 50% to get back to zero. It's all a part of risk management, I guess, and it's all a part of diversifying a portfolio, and it pays off in times like these.
Absolutely. Yeah. And we're going to look at a longer term chart. So this goes back to January 1st, 2020 through the close yesterday on Wednesday, the 16th. And I think it kind of jumps out of why you have all the different assets. It's diversification, as you said, Gary, which is we've had over the last 2 years, we've had pandemic, and you have the huge drop you see here at the beginning. And then we have everything that's going on right now. If you look at any of these asset classes, they've moved all across the board at different time periods. And just like so far this year, you've got the flip where the best performer, even including what's happened so far this year, is, tech stocks in the NASDAQ. That's why we own all of them. That's why we have diversification between them to rebalance between and help depress volatility and all that.
Absolutely.
And bonds are your worst performer for 2 years. And I don't see that changing dramatically going forward as long as things come back, but bonds also depress volatility too. So it has a role. You see what happened here, especially in the pandemic. Everything fell off a cliff except for basically gold and bonds. So they don't move in lockstep with each other. That's why we have them.
Absolutely.
So before I kind of turn it over to you to talk a little bit more about what's happened so far, specifically to, Russia and what that means, I wanted to pull out one more chart, and that, just wanted to look here at basically looking historically what has happened, major geopolitical military events, and what happened to the market, the S&P 500 after that. And as you can see, 1 month, 3 months, 6 months, 12 months later, it's kind of all across the board on what happens, but I think most people would be surprised to see, on average, it doesn't have to be that bad from a financial perspective. Obviously, take out all the uh, human perspective, but from a pure financial stock market perspective, it doesn't have to be that bad. That doesn't mean it won't be. We look here at the Arab oil embargo, and that was the worst that's on this list here, and that could happen again. It could be like that, it could be worse, but overall, just because there's major geopolitical military events happening doesn't have to mean that everything's down and everything's in trouble. That being said, it's not all positive, and there's definitely some long-term ramifications that you're going to touch on.
Yep.
So
I agree.
I will turn it back over to you, Gary.
Okay. Well, we have gone into a new world effective the day that Russia invaded Ukraine. Wars change history. I'm a history buff, and I can't tell you the number of times that wars have changed history going back thousands of years. And this war is going to be exactly the same. None of us have experienced anything like this. I mean, I wasn't even born yet at the end of World War II, and I was too young to remember Korea. But we have most of the last 70 years have lived in what I would call a Pax Americana time of peace, because the US enforced the peace worldwide. Plenty of countries didn't like that. Certainly the USSR, China, and so on. But the fact is the US played a major part, and I would say the dominant part, of helping to keep this world a peaceful world by guaranteeing through our US Navy that shipping lanes would remain open to everybody, whether they were friendly to us and so on. But things are now changing. We're in a period now where we're starting to see, instead of globalization, deglobalization. And we're not going back to the globalization that we had. How far is deglobalization going to go? A big part of that is, what's our relationship with China going to be? That's a huge question mark. None of us really know, but there's no question that there's a big push on. And the US, certainly in Europe, Japan, and so on, to pull back on all of those manufacturing facilities that are in China and other places in the world. What's the ultimate result of that? I don't know. I have to tell you, I think inflation is going to be a part of that, because we're in China because it's cheap, and pulling plants back from China to, whether it's the US or Mexico or friendlier countries to us, there's going to be more inflation coming from that. I just don't see that being something that we can avoid. And any talk of transitory inflation is just, it's off the table. We got to get used to it. Now, the question for us as investors, what does that mean? Well, this is something Ben and I are talking to each other, trying to figure this out as to any changes, if any, that we should make to the portfolio. And we don't have all the answers yet, but we're working on it. A second major thing is something none of us have had to worry about in our lifetimes, but it's agriculture. Ukraine is, and I'm sorry I've forgotten, either they are the biggest exporter of wheat and corn in the world, or maybe they're the third largest and Russia is either first or second. Well, Ukraine is supposed to be starting its planting in the next couple of weeks. There's no planting. Ukraine's wheat and corn, they aren't going to be on the world market this year at all. And think about poor countries that depend upon both Russia and Ukraine for the food that they need to feed their inhabitants. Think Bangladesh, think Africa, think India, and so on. And I'm very concerned, and in fact, you've already seen it in 2 or 3 countries where there have been some food riots. Not that there was nothing today, but people want to hoard it. They know what's coming. And so they're trying to get their hands on everything. And heck, we do that in the US with our infamous toilet paper shortage
That's
here
right.
a couple of years ago, which, was kind of ridiculous, but yet you got the idea. So I'm concerned about what's happening in agriculture. Is there something that we can do as investors to invest in a way that's good for our clients? We're trying to figure that out. The next thing is,
before you move off
yes,
that,
sorry.
and just to kind of speak to that a little bit more, because obviously you and I have had a lot of conversations in the last month about all this, and we've all read, all sorts of things. But one thing that stuck out to me as we kind of talked through this on both sides, as you said, is just from deglobalization. The clients that worked with us for at least the last year. About a year ago, we talked about kind of 5 scenarios of what could happen, and one we talked about was either deglobalization or changing the global landscape from the U.S. role and all that. And what that means for our clients. It doesn't mean we need to go and make a bunch of trades and sell out of all stocks and all, do something dramatic like that. But what it does mean, and tell me if you agree with this, Gary, is whether it's that or it's the agriculture and what that means for inflation and what that means for emerging markets and supply chains and everything around with that. I think it leads to maybe lower expected returns overall going forward. If you don't have the same economic growth because we have a major shock to the system, then you would expect that stocks aren't going to do quite as well. That doesn't mean they have to go to the tank and go down, 50%, but it does mean that we need to lower expectations a little bit on what things are going to do.
Couldn't agree more. What I would add to that is, and what we're trying to do, we're not trying to look for something that we think an area or an industry that's going to be hot for the next 3 or 6 months. We're trying to look at things and understand more that what's going on in certain industries. I mean, agriculture, and as far as that goes, fossil fuels, energy, and so on is another big one. Not for what's going to happen in 3 or 6 months. We're looking out, how is this as an investment category that can be profitable for our clients over the next 5 years, if not longer? There's opportunities, I believe. It's not easy trying to evaluate all the positives and negatives. The only thing I can tell you right now is we're working as hard as we can to try to understand what's happening and then find a way to invest to take advantage of that.
Great. So Gary, interrupted you as you're going to kind of third effect or third impact that you see.
Yeah, and this has to do with the Russian sanctions and really particularly seizing of the Russian central bank reserves. This has never been done. I've never even heard of it being contemplated before. And what that means is every country on the face of the earth has reserves that that country keeps to help it during times of a depression, wars, bad things happening, so that that country still has reserves to buy food, to do what it needs to do to help its population. Well, we just went out and seized, I haven't heard the exact number, but I'm going to say something like 75 to 80% of Russian central bank reserves. That is absolutely huge, because most of those reserves are held in foreign currencies. The biggest part of that is in the euro. Russia even has a small part, I think 3%, 4% in the US dollar. They've got 15% in the Russian yuan. Oh, also, they have about 15% in gold. And in fact, one of the reasons why gold has been going up, because with these concerns, you've seen central banks worldwide increasing to some degree the amount of gold that they hold. Why would they do that? Gold has no counterparty at all. You don't have to worry about, is Russia going to default or have sanctions or anybody else. Gold is gold. And that's been true for, again, many, many millennia, and it's true today. And seizing those central bank reserves could have, and I'll go further, I'll say probably will have some negative effect on the US, because the US dollar and US Treasury securities is this by far the single biggest holding of central banks worldwide. Well, everybody has just seen how, if the US and the Europeans participated in seizing these assets, but would a country be wise to say, boy, I got all this money of my reserves in the US dollar and US treasuries, maybe I should diversify that a bit. How does that affect us? Well, it gives us tremendous leverage worldwide, allows us, quite frankly, to run big deficits as we have been running for 10 years, because everybody wants the US dollar and treasuries. How will that change? I have no idea, but that's a risk factor. It's all a part of how the world is changing, and we need to, we're trying to keep up with that and figure out how that affects us and any changes we ought to be making. The next thing that I'll go into briefly is simply inflation. As I already said, inflation is not transitory. You've seen what's happening at the gas pump. Again, although we haven't sanctioned Russian oil yet, worldwide, people are reluctant to buy it, even at a 20-30% discount, because they don't know if Russia can get it to them. And they're simply very concerned about dealing with a new pariah, because most of the world is on our side and seeing the horrific things that Russia is doing, slaughtering children and so on. You've all seen too much of that on the news already. You don't need to hear any more from me. But so there's going to be a big withdrawal of oil on world markets. Well, we've already seen prices jump. Now the prices come down the last couple of days. I don't see how that's anything but probably temporary. I'm afraid this is going to get a bit worse before it gets better. That's been as far as I'm going to go with this, because I could go through several other things, but I think everybody watching this, you have the idea of how the world is changing. Again, wars change history, and this one is doing it again. We better be looking at those kinds of things that change and that we can take advantage of. But boy, this is right now, it's a big mess.
Right. No, I absolutely agree. You touched on something there. And you said, it's another risk factor, and all these things that you said, are risk factors. But at the same time, if you look at it from an investment perspective, there's a lot more risk factors, but we believe risk and return are related as well. There's a reason stocks over the long run, if you're able to weather through the storms, stocks do better because they're riskier than bonds and so on. And that doesn't mean it's going to be all roses and everything's going to return in the next month or anything like that. But all of our clients are long-term investors. They're invested for the long run. We're looking for opportunities as they present themselves and as we find them, and we'll be reaching out about things like that. But at the same time, this is definitely not the time to say, let's sell out, let's get out of the markets, because when things are scary, when things are uncertain, that's when you want to stick with it and not let the emotions take over either.
Absolutely. That is, we are not headed into Armageddon or anything like that. It's a huge change. I participate in a group on Twitter, and I sent out a tweet several days ago saying, a lot of what I said about wars changing history and so much going on now, but I finished off that with saying that there are people out there that are going to make a lot of money in the changes that are going on, because there are opportunities that are going to arise, and people that make good decisions will make a bunch of money. And there will be people that make bad decisions and that will lose a whole lot of money. And that's part of the new world that we're in. I would also add that people that aren't attuned to what's going on and are just sticking with what has worked for, years or a decade, and aren't attuned to trying to change based upon what's going on, I think they're going to be losers in this. And I certainly don't want to be a loser. Ben doesn't want to be a loser, and neither does anybody. And that's what we're trying to deal with.
Mm-hmm. I think it's well said. I'm not going to blow past the fact you just, mentioned you're on Twitter. You're sending out tweets. You're really hip, Gary.
I got to tell you, Twitter, it all depends on who you follow. And it is a tremendous information source if you're following the right people.
Absolutely. Absolutely. Well, any last thoughts? I mean, I think we covered everything here, and more than anything, it's the same old story we've always said, right? Which is stay long-term focused, stay invested. We'll look for opportunities, and call us if you have a really big concern, but we're not selling out.
Well, all I can say is Shelley and I, temporarily have 2 cats that are boarding with us. So because of that, I will be looking at cat opportunities in cat food.
Okay, fair.
And so on, and maybe cat food futures on the futures exchange. But I'll get back to you if I find anything exciting in cat food.
I thought you were going to say that the cats are paying because you're worried about inflation or something. But
well, no, they aren't.
That's good.
But they are fun anyway.
Absolutely. Well, don't tell my daughter. She is obsessed with cats. She every day she asks if we can get a cat, so we'll probably give it.
Oh yeah.
So,
well,
she's wearing me down.
Okay. Well, that's a good thing. Cats can be fun.
So, well, Gary, thanks for joining us today, and thanks for watching.